Hi, this is Linda Hitt. We're going to talk about leases, usually of property, plant, and equipment, and we're going to particularly focus in on capital versus operating. Leases are basically agreements between two companies or parties. The lessor is the one who owns the property and gives the right for someone else to use it. That someone else is the lessee. Then the lessee, again, during a certain specified period of time, acquires the right to use the property. In many ways, it appears similar to a purchase of equipment or asset, and somebody else sells the asset and it deals with 100% financing. And we'll see that the capital lease is treated as if it were a sale. Sometimes there are tax breaks, tax benefits, because you can deduct the entire lease payment, where often if you own the property, you can only deduct interest on your loan and depreciation. It's certainly convenient for individuals to lease instead of having to purchase and then later having to sell an asset. You allow maybe somebody else to take on some of the risk. Once your lease period expires, then you're sort of off the hook. We'll look at the issue of off-balance sheet financing, which is the case of the operating lease, where you're not disclosing as the lessee the asset as well as the liability. With the lease term, if you cancel, often there's an impact. You can't just easily get in and out of things as you would a purchase sale. Okay, so how are leases classified? The operating format, if you meet certain criteria, you're recorded as an operating lease, and we'll look at the criteria in a minute. Operating lease is definitely simpler. You'll see that very quickly when we look at our example. A lot simpler with the journal entries, and we don't list an asset or liability, so here again is where the term off-balance sheet financing, which it's being looked at with the IFRS as well as FASB. And so we may see I think they're going to come out with a change pretty soon, which leans toward the capital lease. Operating often is more of a short-term lease. We just simply recognize the rent cost or the rent revenue. A capital lease is basically pretending that you're purchasing an asset or selling an asset. For all practical purposes, the lessee picks up the asset and the liability, so we don't have off-balance sheet financing, which just means we leave off the balance sheet liabilities that we know we're going to incur with the lease. Faithful representation, you might remember, as far as one of the concepts, or substance over form. Here's a case where we don't care what you call it, what is it closest to? Which in this case, the capital lease is considered closest to a purchase sale. So there is a transfer of ownership, and it tends to be more long-term. Okay, capital leases, as we said already, it's sort of like a pretend purchase sale, transferring risk and benefits. And for the lessee, how do we decide when something is a capital lease? Well, right now with FASB, with US GAAP, there's 4 criteria that are called capitalization criteria. If any one of the 4 is true, then it is a capital lease for the lessee. And if you look at them, you can kind of see the gist of it. For example, one is just says transfers ownership at the end. Just you become an owner when the lease expires. Bargain purchase option, the lessee can purchase it at a very low price, below fair market value at the end of life. Then the last 2 speak to a lease term that's so long that it pretty much covers the whole economic life of the property. Or in 4, that what you're paying, the lessee's paying for it, pretty much covers the what the asset's worth. So if you have a very long-term lease, or a special price at the end, either no price at the end, you just give it to them, or a cheap price, then it starts to fit closer to a purchase sale. U.S. rules tend to spell things out, where the international tend to get more sort of a general thing. But they're working on this together to make some revisions. Then the lessor, if one of those 4 is true, then the lessor adds two more on, and the two more both have to be true for the lessor to use a capital lease. So the collectability of your lease payments has to be pretty likely, and there shouldn't be any special issues around what they call unreimbursable costs. Whatever the lessor incurs to have the lease, things should be pretty well spelled out. Okay. So for the lessee, for the capital lease, again, they will record an asset. We'll do an example here in a sec. We will be using present value concepts, either present value ordinary annuity or a present value annuity due, to come up with the value for the asset. And this value should never be more than the fair value of the asset. Of course, sometimes the lessee does not know what the fair value of the asset is. If they do figure out the present value, then you need an interest rate. The interest rate is basically if the lessee, of course, they know their own borrowing rate, the implicit interest rate. They may know the lessor's rate, or they may not know the lessor's rate. If the lessee knows their own rate, the lessee's rate, and the lessor's rate, they pick the lower of the two. So if the lessor's rate is lower, then we pick the lessor's rate. If the lessee's rate's lower, we pick the lessee's rate. Obviously, if you don't know the lessor's rate, you don't have to worry about that. You just pick the lessee's rate. So then that's used to figure out the present value. So we will see for capital lease, for the lessee, we'll have an asset on the books. Just they pretend they buy an asset, they pretend they finance it, so they have a liability. They deal with interest as part of the cost of the borrowing, and they even depreciate the asset. So that for all practical purposes, the impact will be just as if you bought it, if you use a capital lease. For the lessor, they pretend to sell it. And so the sales type lease, if the lessor manufactures the goods and then routinely rents them out, they have their own cost and then they have a fair value. And so that will look very much like a debit cost of goods sold, credit sales. Debit cost of goods sold, credit inventory, finished goods inventory, merchandise inventory, whatever. It's as if that they have these goods they can either sell or they can rent. You'll create, of course, a receivable for monies collected. There'll be an interest earned component to it. So the good news, the sales type lease, the first entry is a little more complicated, but the rest of the entries are very similar to the direct financing lease. Here, you just take something that you purchase and immediately turn right around and lease it, and there's not a wholesale versus a retail price for it. So the only thing you're really earning in a direct finance lease as the lessor is interest revenue. Okay, so let's escape ourselves out of there, and whoops, let me pull up my example. Okay, so here we're going to take a look at one lease. We'll go through 1 year, and we're going to, first gyration, we'll say the lease payments happen always at the beginning of the period. In the second gyration down here, you'll see that we look at the same lease, but what would happen if the payments were at the end of the period, at the end of the year. And then the third option is short and sweet, which would be looking at it if we record the lease as an operating lease. And I thought I made nothing I need to worry, but let me make this a little bit larger so you can actually see it. So those are the three different ways from the same basic facts. So first we can start out, and of course again, with a capital lease, which is what we're looking at, the lessee has to pick up the asset and the liability. So we can call it something like capital lease payable. Leased equipment distinguishes it from other owned equipment. But the only thing is, what value are we going to use? What we know so far is we signed a non-cancelable 6-year lease, beginning of the period payments. We do know both interest rates. We know the lessor rate is 10%, and we know the lessee rate, it's like I misspelled that, is 11%. So we're supposed to use the lower of the two. So we'll be picking up and using 10%. Okay, the payments are given. We can mathematically figure those out. But there's the payments, and then the payment is $31,310.10 that you have to pay annually. And then it says assume item costs the lessor $100,000 to make, and then we're asked to use the sales type lease for the lessor. All right, let's do this. Let's do the lessee entry, and then we'll work over to the lessor. So one thing I have to do is figure out what is the present value of the future cash flows to put a value on the asset and the liability. So if it's beginning of the period payments, and of course it's 6 years, same payment each year of 31,000 some dollars. It definitely is an annuity type problem. We need to know in the present what the value of those future flows are, so it's a present value problem. And if it's beginning of the period, beginning of the year, we could have done one with monthly payments. We just try to keep it short, so we're using yearly. It's going to be present value of ordinary annuity. So I'm going to come over here. I'm sorry, present value of annuity due if it's beginning of the period. So here's n equals 6 for the 6 periods, and our interest rate again we're using is 10%. So I'm going to go ahead and use the Excel function for present value. Whoops, if I can type. So there's a PV, go and then OK, and so I'll just enter the data. So I'm just going to type it in. So the rate is 6%, oops, the rate is 10%, make it a percentage, 6 periods, payment is what we quoted, well, I'm just going to take it off of here, it's $31,310 and 10 cents. There is no future value. Once the payments are all made, the loan is gone. And then it asks for type. Payment at the beginning of the period equals 1. Payment at the end equals 0, or you just omit it. So this is definitely beginning of the period, so the type should be 1, so that it works out mathematically correctly. Okay, so we come up with 150, and it always comes out negative, but anyway, I'm just going to, you can use your absolute value there. Okay, so 150,000, I'm going to forget about the 1 cents. So we'll type in 150. And that again is the present value of the future payments. And let's go ahead, and since we make the payment right away, there's no time, there's no interest, no passage of time, so that first payment is 100% principal. That's only true of payments at the beginning of the period. So the $31,310.10, 10 cents. We simply debit the capital lease payable, credit cash. So we started with leased equipment debit, capital lease payable credit for $150,000. Now we're going to debit the payable for the $31,310.10 and credit cash for $31,310.10. Okay, let's see what the lessor does, and then we'll eventually get to the impact on the statements. Okay, we were told the lessor, we're supposed to use a sales type lease, and it costs the lessor $100,000. And just assuming now that 10% is the lessor rate, then we would assume based on the payments that the cost, or what the item is worth for the lessor too, is $150,000. So we will set up a receivable from the lessee. That receivable should be 6 times that $31,310.10 payment. So I've got a spot over here to write it. So you take the payments times 6. And so we have 187,870.60. Okay, so we'll fill that in. And again, I'm not going to use Excel, we'll just type it in. Okay, remember that includes everything, all the payments. We're going to make this as a giant compound entry. I could make it 2 entries. Let me do 2. I think maybe it'd make it a little easier to work out. So between you and the customer, this is the retail side of it. But the receivable, the item's worth 150, but we're going to get 187,860.60 because there is interest involved. Right now we haven't earned any of that interest, so I'm going to type in unearned interest revenue. And we will take, record the sales, do all the retail part of it. The sale would be 150,000 because that again is what the item's worth. So the difference between the receivable and the fair market value of the item, that's going to be our interest. Over time it'll become interest revenue. And then step 2 would be to recognize the cost of, in essence, selling the leased equipment. So here I'm going to put in cost of goods sold, and I'm going to call it inventory. If you manufacture, it would actually be finished goods inventory. So I'll put FG inventory. Okay, and we were told in the original data that was 100,000. So with the sales type lease, you got two things going on. You're earning revenue because of interest, because you're just tying up, your money for 6 years. You're also earning sort of manufacturer's profits. You're making the difference between your sales revenue and your cost of goods sold. So it's like $50,000 gross profit is another form of earnings that you've got. So you can see the lessor had a lot more going on, like with the sales type lease, a lot more certainly than the lessee. So let's see if we can follow with the impact. So I put the green here, meaning this is the lessee's part. So we have property, plant, and equipment going up. You've got a liability going up. Okay, so I'm just going to add to assets. Remember not to do that. And add to liabilities. So that balances the balance sheet. Until we pay interest or accrue interest, depreciation, we don't have really any effect on retained earnings or stockholders' equity. So therefore also not with profit and loss, and we haven't paid for it yet. So that's pretty much it for the lessee at this point. And then the lessor has a lot of things going on. I don't want to put numbers into my impact. As you can see, A for assets, L for liabilities, SE for stockholders' equity is the impact on our balance sheet. P&L, profit and loss, or income statement, we're looking at just the effect on the bottom line. And then the cash flow statement, we can look at cash in or out, and whether it's operating, investing, or financing. Okay, so here, let's see if we can gather the assets together. So we have a receivable, 187,860.60. The next asset I see is way down here is finished goods for 100,000. So the receivable is definitely higher than the finished goods inventory. They're both assets, in fact, both current assets. So we definitely would expect with this that the assets would go up. Okay, what else happens? We have unearned interest revenue, which is a liability. No other liabilities, so liabilities also increase. And if you look at the numbers, if we just pop that up for a minute, the 187,860.60 minus, that's the receivable, minus 100,000 finished goods inventory is the 87,860, which actually is all the earnings, which would include the fact that the sales revenue and 50,000 profit, but we're also eventually will have 37,000 some over there. So our assets are going up by 87,000 some. The liabilities are going up, but obviously not as much. And then we do have revenues and expenses. So we have sales revenue of 150, cost of goods sold is an expense of 100,000, so they net to 50,000. You have revenues more than expenses, so the revenue nets with the expenses. So retained earnings should go up by 50,000. So stockholders' equity would go up. when we do closing entries. And also your income statement would be higher because of the gross profit, the difference between revenue and cost of goods sold. And at this point there's no cash, but we have a lot of pluses on the lessor side. Okay, then the lessee makes the payment. Without interest, no time passage at all goes against principal. The same deal over here for the lessor. They see their receivable going down. No interest is shown at this point. So it's the same amount, $31,310.10. And then what's the impact? You're paying a liability. So you have liabilities going down and assets going down. So we'll pick that up. Whoops, not like that. Assets and liabilities. No effect on stockholders' equity. No retained earnings impact. No profit and loss impact. We do have a cash flow. So if you're paying on a lease and it's because you bought a long-term asset, then you're paying for the liability part of it, I guess. So we'll put down financing or paying a liability. Okay, and then the lessor, cash and accounts, a type of receivable, would be simply an asset exchange. One asset up, the other down. So we can either leave it blank or I can do a plus line and a minus. How about if we do it that way? Whoops, they didn't like it. I need to put in, if I put in a single asterisk, then it won't recognize it as a formula. Okay, so that's the first entry. The good news is we're only going to do that, and we're going to do the end of the period entry as well. So let me come back over here. We recorded the lease, we made the first payment, or collected the first payment. Now we're asked to do whatever adjusting entries are appropriate. So the lessee has pretended to buy it. They have the asset liability. They paid against the liability. End of the period comes and we should accrue interest on our loan. So we'd have interest expense and interest payable. And the question is, how much? So there's a couple ways we can handle this. Maybe now's a good time for us to come over and let's look at our amortization table, which you can set up relatively easily, which I think, whoops, should be the first one here. Well, eventually, the other things to the far right is for the end of the period payments. So here's the $150,000 amount that was the asset and the liability. So that's our liability for the lessee. This is what we, in essence, have borrowed. We make our first payment on the amortization table, which, as you know, is always the same amount. The first payment's made so early on, there's been no passage of time, there's no interest. So there is no interest on the balance. We have zero there. Therefore, the entire payment reduces principal so that our remaining balance is simply the $150,000 minus the $31,310.10. So our liability has come down. Then the next year we would make the payment, which I guess happens every January 1st. And this time we have, if I click on it, 10% times the unpaid balance the previous period. As you can see, you can see the number. We just are dropping a digit. The interest is less because the unpaid balance is less. And then here, principal reduction is simply the lease payment minus the interest on the loan. And then the remaining balance is simply the previous balance minus the reduction to the principal. If you work through that each time, you see the interest expense is less each time because the unpaid balance goes down, which is basically the effective interest rate, until you make the last payment in the last year, and it's off because of rounding, but it's basically zero. So that's for the lessee. And then we have the lessor over here. looks really different, but we have more columns, different titles, but basically it does kind of the same thing. So yeah, the difference over here is the lease receivable. If you remember this figure, you may not, is the total. It's the 6 times we made the payments. If I go back to the entry, whoops, 20. I know what it is. I'm sorry. I'm looking at here's the one that we need. No, that's the lessee, beginning of the period, 206. Let me just put in what we had because I know we did this properly. Not sure what happened. Sometimes that's the reason not to type anything in. It should have been amortization table lessor. Yeah, that should be because this is at the end of the period. Yeah. So we use for the receivable the 187, which is right there. Okay. Let me put that in and see what happens. 187, 860.6. The unearned interest should be the 37, 860.60. Okay, that looks all right. And then you've got the net. Okay, I think this works out. I'm not sure why that was different, but who knows. So the net investment is simply the lease receivable, which again is all those payments, less the interest piece of it, which starts out as unearned interest. So the lease receivable less the unearned interest equals the net investment. The net investment is equivalent to what the asset is worth. So in a sense, this is the asset component on the lessor side. On the lessee side, it's the liability. And then the only difference, works very similar. You can see the same payments here that we had over here. The first payment happens right away, so it's really like a down payment from the lessee, and it comes right off of the loan. So there's no interest on the first payment. The receivable goes down by the full $31,310.10. The unearned interest doesn't change, but the net investment does. Again, some of that's been paid off by the lessee. So it works then throughout the rest. And you can see our interest matches up because we're using the same interest rate, same terms. So slowly the net investment comes down to zero when the, lease term ends. And the lease receivable is zero by the end when you make your last payment. And all the interest is earned 2 cents off because of rounding. So those are the amortization tables that we're using. So when we deal with the interest, that's one way to get it, is to look at what's going to happen on January 1st of next year. We can accrue at the end, very last day of this year. It's like 1 day's difference. We can pick that up. So we're going to pay tomorrow $11,868.99, which is again 10% of the unpaid balance. So $11,868.99. 11,868.99. Okay. So that's the accrued interest. Left a 1 out. Okay. And because we pretended to buy it, we're also going to pretend to depreciate it. So the only difference we'd have is depreciation expense leased equipment on the lessee and accumulated depreciation leased equipment as the credit. And we're going to just go ahead and use straight lines. So if the asset is on the books, if you remember, at $150,000, 150,000 divided by 6 is what? Let's type it in. 25,000. Not sure what that is, but I might take that off. So $25,000 each year for the next 6 years would be depreciated. So you can see when you look at the lessees, it's basically looks just like if you'd bought it and make your payments and depreciate it. At the very, very end, what we should expect to have is leased equipment still on the books for $150,000, and accumulated depreciation at that point in time, since we have no salvage, would be $150,000. So eventually you would just close everything out. So at the very, very end of a lease, you would debit your accumulated depreciation to close it, and you would credit the leased equipment to close that, and all of that would come off the books. Just to kind of follow that through. Okay, let's see if we can do the lessor side. If the lessee accrues interest expense, then guess what the lessor does? They also have to deal with interest. The only difference here is that they already have an unearned interest account. So we're going to reduce the unearned interest revenue, and we're going to pick up interest revenue. Okay, we're going to use the same number as the lessee because we're using the same interest rate, same number of periods, and so forth. Now, it's not always going to be true, because we know that if the lessee's rate is lower than the lessee is going to use the lower of the two rates. So we may be using a different rate. We don't have to depreciate the asset for the lessor side because the lessee did that. And we won't worry about the closing part. So what is the impact of accruing the interest by the lessee? Accrued expense, as an adjusting entry, we know should increase liabilities, and because the interest expense is closed into retained earnings, should reduce stockholders' equity. Also, it would reduce our income statement profit, our P&L, where the lessor is moving it from a liability, unearned interest revenue, to a revenue. So our liabilities would be going down. If we have a revenue, that means our retained earnings would go up. So we balance the balance sheet that way. And our P&L, profit and loss, would be going up. And that's it. Okay, and then the depreciation that we have on the lessee's books, it's an asset used up. Sometimes we also recognize it as deferred expense. We set it up as an asset, deferring it to a later time as an expense. So whatever you want to call it, your assets are going to come down through accumulated depreciation that reduces assets. Depreciation expense closes into stockholders' equity to retain earnings. So that goes down, and your profit and loss, your net income, is lower. So we have a lot of negatives there. Okay, and then the closing of the accounts for the lessor is an asset exchange. Leased equipment goes down, and accumulated depreciation goes down. And I should put that, yeah. Okay. Okay, so that hopefully gives you an example of beginning of the year payments, calculating the present value, doing the journal entries, impact on the statements, and looking at the amortization tables. So next, let's try the same example, but what if the payments have happened at the end of the period? So we're going to again use 10%, but because they're at the end of the year, the payments are a different amount. We talk about the same asset. The lessor has to wait for their money a little bit longer, so the payments are going to be here higher. So we have $34,441.11 are the payments. So this time we need to once again value our asset for the lessee. So if it's annuity, present value certainly, but end of the period we have present value of ordinary annuity. So we'll again use the built-in Excel function for present value. I'll click on PV and get my little pop-up box and go through the terms. So I've got 10%, 6 periods, payment 1.11, $34,000. No future value. Type, this is end of the period, so I can either leave it blank or put in a 0. So once again, I've got the same 150,000 as my present value, which of course I intentionally worked out so that the payments would make up the difference. So yeah, let's go ahead and put that in once again. So let's see here. So I've got same titles, leased equipment debit, and capital lease payable credit. And it comes once again out to 150,000. Okay, we won't worry about the impact on the statements this time because we have the same deal. This time we're using a direct finance lease for the lessor. So with the lessor, we assume this time there's no manufacturing profit. They just bought it and turned right around and leased it. So they bought it for 150,000, which I guess I didn't really stick in the payment of it. But assume that it's on the books, and so all they have to do is take it off the books if they pretend as a capital lease to sell it. So we'll have our receivable as a debit, and we'll do the math here in a minute. They will credit the account that they have recorded when they bought the equipment, which is the equipment account. And once again, we should have the potential there for interest earnings. So unearned interest revenue is a credit. So it is shorter than the sales type lease. The receivable will be the same idea, but come back over here. We got $34,441.11, and we have 6 payments. So we can do that times that. So we have a larger figure there to deal with. Oh, what did I wonder if I reverse these? I don't know. No, that's not right. So this one should be a higher receivable. I was just looking at the amortization table. Let me see if I can put in 206646.66. Okay. All right. Yeah, so if we come back over here, I won't worry about the amortization table yet. 6 payments. I will go ahead and put in, and it is somewhat larger because again they have to wait longer for it. The equipment we assume has a fair value and was purchased at 150,000. So the difference between the receivable and the equipment balance comes out to be $56,646.66. Okay. So that gets it on the books. No payment happened right away. So when the end of this year, we'll deal with the payment. So we know the payment is $34,441. So we'll make the payments for that. And because we're paying it and it's at the end of the period, then we really need to deal with principal and interest. So it's a little different with the end of the period. So in our entry at the end of the year, we should have capital lease payable. We should have interest expense. Can't type at all. And we should have cash. Well, cash is the easy part. $34,441.11. That part we can always remember. And yeah, let's go look at our amortization table for the lessee, which is over here. So if we remember, once again, we're starting with a loan of $150,000. We were given the lease payments of $34,441.11. So the first year we have 10% of $150,000 gives us $15,000 interest expense. Then we know that the payment is partly principal, partly interest. So to figure out how much is principal, we take the total lease payment minus the interest balance, and that's the reduction to principal, and then the remaining loan balance is what you had last period minus the reduction from this period. And of course it mathematically works out beautifully that it should come basically down to zero or be very close because of rounding. Okay, so we have $15,000 and the amortization table has all the information I need to make the journal entry. So if you can sort of see that, we can do it. So capital lease payable, well maybe, is the 19,000. Again, I'm not bothered to use Excel. 19,441.11. The interest is 15,000 as we mentioned. We could do an auto sum and make sure I've got the math right. Whoops, it would help if I do that. Yeah, see what I did. Okay, it comes out. It's not a bad thing to check your math. Okay, so there's the payment from the lessor, lessee rather, end of the period. And that payment, again, is partly principal, partly interest because there's been 12 months, so we need to pick up the interest. So because it's made December 31st, then we don't really have to accrue interest. And then the lessor has an entry to make as well. So they will pick up their, they'll collect, not make a payment. So they're going to pick up cash and their receivable will come down, and it's going to be the payment that we've mentioned many times before, so I won't mention it again. Okay, but with that entry we haven't dealt with interest yet, so we'll do the interest as an adjusting entry. So it's a little different take on it, but it's still going to come out. So remember, the interest was first put into the unearned. So in the adjusting entry, we'll do unearned interest revenue debit to reduce that, and we'll transfer it over to interest revenue as a credit. We know the amount. We just did, excuse me, the lessee. So it's going to be 15,000. And then let's see. So if we look over here, I think you'll see the lessor. And there's the 15,000, the interest revenue. And remember, the receivable less the unearned revenue equals the net investment. So it's kind of their value of the asset. Starts out, and then slowly we amortize it. Receivable drops, we recognize the revenue out of unearned to the interest revenue. So I think the amortization table for the lessee is more logical. We think about loans, but let's always do the lessee first. Okay, so what do we have left to pick up? We do need to depreciate from the lessee's standpoint like we did before. So depreciation on the leased equipment, debit depreciation expense, and credit accumulated depreciation. And the number 25,000, we remember from the first gyration, well, the fair value is the same. It's the same 6 years, so guess what? Same 25,000. We don't have to redo that. Okay. Again, we won't look at the impact because it's the same titles, just the amounts were different. And then once again, at the end of a lease, you would close out what's there. So you close out your accumulated depreciation, and you close out your leased equipment. So debit accumulated depreciation, credit leased equipment. At that point, everything's been depreciated. Okay, and I think there's not another entry for the lessor. So you can see with the sales finance, direct finance lease, It's simply taking off the asset from the books, receivable and unearned, collecting the money is always cash and receivable, and then you still handle the unearned interest adjusting entry separately, just like we did the first one. But with the end of the period payments with the lessee, with beginning of the period payments, you accrued the interest later. With end of the year payments, you can make that part of your payment entry. Okay, and the third possibility, which you'll like the best, I do, is the operating lease. And right now, again, they're moving away from that. I think the way it looks is that if the lease is a year or less, it'll be treated as an operating lease. But if it's more than a year, it looks like they're moving towards, in their exposure draft, making all of those leases capital leases. Well, I should be careful how I say that. It sounds like leases in general will pick up assets and liabilities, whether they're, well, possibly they're operating or not. But anyway, we'll get there when we get there, right? So a operating lease simply takes the payment. We went back to the first payment, so this is beginning of the period. So if you're prepaying something at the beginning, you could start out with prepaid lease and the cash and do the payment amount for the year. $31,310 on 11 was what we started with. And the adjusting entry at the end of the period would be to expense it, just lease expense and prepaid. So look how much easier this is than the capital lease. That's as complicated as get. The lessee does not pretend to buy it. They don't show all the liability that they're incurring because of signing a non-cancelable lease. Which is why, again, they talk about the off-balance sheet financing. We don't see capital lease payable of $150,000. True, we don't see the asset either, but there's ratios that are really impacted by not showing the debt. So that's the big criticism, and I think that's why they're moving towards more leases picking up assets and liabilities. And then on the lessor side, it's also pretty easy. They're going to simply collect the money up front, and initially when they collect the money up front, they haven't earned any of it, so it's cash and unearned revenue, and again the same amount as before. And by the end of the period, they are going to simply do an adjusting entry so that whatever they recorded as unearned, they will reduce the unearned and recognize interest revenue. Or actually, I'm sorry, lease revenue. So you can see just how, short and simple this is. And of course, we're not even looking at the footnotes and all the other disclosures that you would have that goes with that. So for the lessee, if we look at the impact, I guess I can just do it. Well, yeah, it's simply an asset exchange. So plus and minus under assets. And I can cheat and pick it up here. That way we can kind of show it as that goes with the green. And then the other, the lessor, is picking up an asset and a liability with the operating. And then I'll just do, whoops, I can do it this way, I think. A little bit of blue. Okay, so you can distinguish the two. And then the adjusting entry is assets used up for the lessee. So we're looking at assets going down. And expenses cause retained earnings to go down, so stockholders' equity goes down. Profits go down. And we can show that again as green. And then last but not least, we have the adjusting entry for the lessor. So we do see liabilities going down and retained earnings would go up because of the revenue. Profit and loss would be up because of the revenue. And that's the final piece of that. Okay. So again, you can see we don't need an amortization table for the operating lease because we don't have interest expense and interest revenue. It's just simply whatever you pay for the lease, either an expense or a revenue. We may start out with the prepaid first. Okay, so hopefully that gives you some background in the basics for leases.